50 days, 5 banks and counting. Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Alex, who's been looking at this situation that has been unfolding over the weekend and continues to unfold. We actually expected some sort of resolution by now, and we haven't got one. So it's all happening, and it's great to have you here, Alex.
Thanks for having me again. Nice to see you.
Yeah, nice to see you. We were discussing this a little bit earlier in the day. We're sort of preparing for our discussion now, and we thought by now we'd have a resolution, but we don't. So we've still got this situation where we've got First Republic, collapsing effectively, but not sure who's taking over, what's going on. So can you start us off today with just a bit of background about what this situation is for First Republic, and maybe some comparisons to how they sort of compare to the other banks that have had this situation?
So we've now had 5 banks: Credit Suisse, we've had SVP, we've had Signature and Silvergate. So the first one, which was SVP, collapsed on the 10th of March, which officially is 51 days ago. So we hope to hear some sort of resolution by this morning. So they were working through, the FDIC supposedly took control on Friday. They were working through the weekend. We were meant to have resolution by the bell this morning for the Asia market.
Mm-hmm. Which has since passed by a number of hours, hasn't it?
Yeah, we're well past that now. And then it's European May, Labor Day at the moment. So that market's not open, but the US market opens soon. So they're struggling to get through it. So just to give you, we spoke about SVP not being a big bank, even though I think it was the 16th biggest bank in America.
Certainly wasn't small.
So this bank was the 13th biggest bank. So at some point it had about 200 billion US in assets, and that compares somewhere between somewhere around Macquarie Bank in Australian terms. Right. So not a particular, Macquarie Bank's a little bit bigger, but not a particularly small bank. And it has seen its share price fall from 3 billion US to 650 million on Friday, at which point the FDIC seems to have taken over. But there are sort of people talking about the fact that the liabilities are now bigger than the assets, and it could be anything to negative $14 billion for market cap.
So a situation where it's potentially negative by that scale is problematic for anyone looking to buy it, isn't it? Like that's going to be a big problem.
You don't really buy a company that's got negative equity. And then if we look at the Fed raising rates, we know that the issue with this bank is that it's had all its deposits moved away, which is cheap debt.
Yep.
And it's had to buy more expensive debt. And if the Fed raises interest rates on Friday, that debt is even more expensive. So right now, it's negative 14. As of Friday, it might be more.
So why has this happened? Can you maybe dig into that part a little bit more? Because you make a really good point in the article today about this being effectively logical, right? Like that this is not necessarily a decision that any person would make differently, and it wasn't necessarily bad management of a bank or any of those things. It was just straight out logic that that's what you would do. So can you maybe explain a bit more about that and this idea of, is it contagion or is it just common sense?
So contagion is when something escalates, and definitely we saw SVP, we've seen First Republic now. Twitter gets on, everyone says this is the next bank, and everyone withdraws their money. But people are withdrawing money because they've got other places to put it, which is making more money for them. So I mean, common sense is, if I can make 1% with money in a bank that might fail and I might lose my money, or I can make 5%, give it to the US government. I might have to lock in for 3 months, a year, but my money's parked there. It's looking pretty safe and I'm earning 5%. Isn't common sense move your money? So Yellen was the one that used the term contagion. I think people during COVID learned that they could trade their money. I think they learned that they could make money in their own way.
Yep.
And banks, offering 1% are behind the 8 ball. but their hands are tied too. These interest rates have gone up so rapidly that they just haven't had a chance to catch themselves. And people, you've got 17 trillion in deposits in the US. I mean, you work with Ainslie, how much money has been moving just to gold. Now, gold makes 0% return unless it's on the price, but there's no counterparty risk. If you're looking for a return, government bonds are fantastic.
That's right. And that, just on that point about Ainslie, the conversation I'm having with customers all the time is they're saying, oh, why is it so busy all of a sudden? And I say, well, it's not all of a sudden. It's been since since this 50 days, since the first bank really started to fall, where people have just lost that little bit of confidence and go, well, maybe they were sitting on the sidelines and weren't really sure if they wanted to buy gold or silver, but all of a sudden they've decided, okay, let's just at least buy some. And I have that conversation over and over again with people saying, let's at least buy some, because we're just not sure anymore in this world where we've got, ever since we had the first bank fall, but bank after bank, we've got them falling. It's a real concern for people.
Yeah, so that money's taken out of the system. That money is cheap debt for a bank. And so as that is taken out of the system, they are replacing it with not 1% or 3%, whatever they're paying on deposits, they are replacing it with 5%.
Yep.
And that's why people should calculate and look at what that does to bond prices. Just look at what a 5% interest rate return over 5 years on a bond price does compared to putting it in the bank. The difference is about $320 over $1,000. Like, it's a huge sum of money.
Huge.
Yep. And that's what banks are having to replace.
And you put the link in the article actually to that little calculator. It's a worthwhile exercise for people to do if they don't understand that, to realize, oh, okay, this is why it's common sense. Like, this is why you would make that decision as an individual, but also why the banks are logically falling or folding or collapsing under this environment. It is all logical when you actually do the maths, isn't it?
That's right. So the FDIC insures deposits of $250,000. So, if you've got $10 million, you can park it in 20 banks and you'll be insured in each of them. But, what does that look like?
That's not practical. Yeah.
It's crazy. Or you can just buy a government bond and you're guaranteed it anyway. So, what are they asking people to do, and what are they saying is contagion as opposed to just common sense?
Sure. And you mentioned it before, but I'd just like to dig into it again. What does this actually mean for the Fed? Because we have a decision coming up this week. It feels like they're in a no-win situation, but what's your sort of take?
I mean, the Fed's a bulldozer that's just going to keep bulldozing things. But, you look at right now, we're past the original deadline. So Asia market was meant to be when there was a decision made. Unless the FDIC offers money to somebody to buy First Republic, no one is going to do it. So they are going to lose some insurance deposits no matter what. The deposit insurance, it's going to take a hit. But if the Fed then raises on Friday, it's an even bigger hit. So, there's no collusion because central banks need to be independent. But surely you've got to look at the bulldozer that's going through right now and just ask if a pause is not warranted.
Sure, absolutely. And sort of further to that, do you think that that's coming into play with why this is taking so long? Like, we absolutely expected more than 8 hours ago now, probably, really to know what the outcome of this situation was going to be. And the fact that we still don't know is probably sending a message.
Well, I mean, Friday's decision makes it more expensive. So and that is 4 days away. Why, if you were a bank, would you be committing to something unless you're compensated in full for Friday's decision? And if I was the FDIC, I wouldn't do it. So I'd suggest it's a stalemate.
And that would be one explanation for why we still don't have an answer on the resolution. But it does worry me because when we've talked about this in the past, that it's not an unlimited amount of money that's available there to continue bailing these banks out. And, 5 in a row that doesn't mean it's the end. I suppose really to wrap this up, do you think it's the end? I mean, I certainly don't. I think that we could see another one and another one and another one. And now that people are looking for blood, they'll be that, you know, that you talked about the Twitter army sort of out there looking for the next bank that's going to fall. It can be a self-fulfilling prophecy. There's a lot going on here. What's your sort of take on that about, is this the end, or what can they even afford to keep bailing out banks? What happens if we get another 5?
So this one almost caps out the FDIC. So I confidently say that it doesn't have another, they don't have another 5, maybe 1 or 2. But this will then come back to the US government, what they choose to do with this. They are running out of options. And I mean, the JP Morgan guy the other day just said you'd be foolish to believe that this is it, because and it is,
and not to mention they're one of the banks that or a likely contender to be the bank to take it over.
Absolutely. But they're being limited because apparently they hold more than 10% of the country's deposits right now, and they're not allowed to. So they're going to have to bend the rules just to allow them to do it. So nobody thinks that this is the last one. But, you know, we've had Credit Suisse, that was huge. We've had SVP. Now this one's the 13th. Do we keep going down the chain now? Are they, you know, is it the next one going to be the 10th or the 9th bank? Like, they're getting bigger and bigger. This is the second biggest one in US history behind Washington Mutual, which was 2008 when all of this was going on, the GFC was going on. It doesn't look like it's the last one. And the GFC, all the rules that were put in place were to fight deflation. This is inflation. It is totally different. And you've
rules,
now got a more educated layman who goes, well, why wouldn't I put it in shares? Why wouldn't I put it in gold? Why wouldn't I put it in government bonds? Why does my money need to be sitting in a bank right now?
And my sort of last point on that would be, if you're remembering that the US is very different to Australia and that they have thousands, like literally thousands of these smaller banks. If we get to the point where there is no more money in that insurance fund and depositors actually take a loss on the fall of one of these banks, I just see that as absolute chaos that comes out of that decision. I think it'd be very dangerous for the government to allow that to happen, but it may just happen because they don't have the infrastructure in place to not let it happen. I don't know. But the moment that happens, everyone runs. Like, if you're in any of those small banks, you run for the exit.
I mean, you've got the FDIC guaranteeing 250,000. Maybe they need to move that up to $1 million to give people a comfort. But we also spoke about when SVP collapsed, that there were enough assets at that point that they didn't need to guarantee it. So, you know, they've fired a blank pretty early, and maybe they've got no more of those.
That's a very good point. Well, I think we're just going to be sitting here and waiting. Sometime, I imagine, later today, we'll find out the outcome of this particular situation. But it certainly doesn't it matters, because it probably lays a little bit more of the groundwork of what happens for further banks going forward. But I think we both agree that this isn't the end. So in some ways, it doesn't matter, because whatever happens, there's still another one coming and another one until the fundamental problem is solved, which is that mismatch between rates and the bank's ability to earn a profit. Yeah.
So you've got, like we've talked about, you've got those super cheap loans that they've written. They had deposits. Those deposits are now leaving unless the interest rates between what was previously the debt level of 1% during COVID or thereabouts, unless that pulls back down, this will keep happening. And the further apart it gets, the faster it happens.
Well, thank you so much for that today, Alex. We'll be tuned in, watching to see what that next move is. And it'll, like I say, it should be in the next few hours, I would expect.
Hopefully a positive one.
Hopefully. Thanks everyone for watching. Remember, reach out with any questions, comments that you have on the social platforms. We'll get back to you on those. We'll discuss those as we can. That's us for today. Like I said, we'll be watching closely to see what happens next. And of course, how these things impact markets and metals. So I'll be back on Wednesday, probably with Branko, I think, at this stage. So we'll no doubt be looking at the other side of this to see what's actually happened, because he was talking about this last Wednesday. So certainly been on our radar, and we'll be going forward. Thanks, everyone. I'll talk to you later.